There is a tax strategy that the wealthiest families in this country have been quietly using for decades to fund comfortable retirements, spend freely, support their grandchildren, and avoid paying capital gains tax along the way. It is completely legal. It is written into the tax code in plain English, and almost every senior who hears about it for the first time asks the same question: why did nobody ever explain this to me before? The strategy is called buy, borrow, die. Over the next several minutes, I am going to walk you through exactly how it works, why wealthy families have built generations of wealth around it, and, most importantly, the honest truth about whether it makes sense for an ordinary retired American, or whether it is a strategy that can quietly cause serious financial damage if it ends up in the wrong hands at the wrong time. Because here is the part you almost never hear on YouTube. Buy, borrow, die is a genuinely powerful tool for people who can afford the risks involved, and it is a financial trap for people who cannot. By the end of this video, you are going to know which group you fall into, how the 3 core mechanics actually work, the 5 real risks that almost every other video glosses over, and the specific questions to ask before you put any portion of your retirement on this path. Let me start with a story, because the strategy makes far more sense once you see it applied to a real situation. Imagine a 67-year-old retired hospital administrator named Barbara. Her husband passed away 3 years ago. She owns a paid-off home worth approximately $620,000. She has a brokerage account her late husband built over 30 years, now worth roughly $1.1 million, most of it in long-held stock positions carrying enormous unrealized gains. She holds a whole life insurance policy with about $90,000 in accumulated cash value, and she draws a small pension combined with Social Security that together bring in about $4,200 per month. On paper, Barbara is a wealthy woman. In reality, Barbara came to a tax professional last spring in tears. She could not figure out how to pay for a new roof, a hip surgery her insurance was not fully covering, and a trip to visit her son in Germany, all in the same year, without triggering a tax bill large enough to push her into a higher Medicare premium bracket and cost her thousands of additional dollars on top of the capital gains. She was, in her own words, asset rich and cash poor. She had nearly $1.8 million in net worth and was afraid to spend any of it, because every move she made was going to be taxed. Barbara is exactly the kind of person Buy, Borrow, Die was designed to help. And once you understand the 3 mechanics, you will see why. Soldars. Mechanic 1, buy. Buy means you accumulate assets that grow in value over time. Stocks, real estate, a business, a whole life insurance policy with cash value. These are the engines of long-term wealth creation. They appreciate while you sleep. And here's the most important thing to understand about these assets: the growth in their value, what tax professionals call unrealized gain, is not taxed. Not a single dollar of it. The tax code does not recognize appreciation. It only recognizes sales. If your investment account grows from $100,000 to $1 million over 30 years, that $900,000 in growth is completely invisible to the Internal Revenue Service, right up until the moment you click the sell button. The tax does not exist until you create it. Most retirees never fully internalize this distinction. They think, my account is worth $1 million, so if I need $50,000, I will sell $50,000 worth of stock. And the moment they do that, they have voluntarily stepped into a taxable event that never had to happen. Mechanic 1 says the opposite. You buy, you hold, you let the asset appreciate, and you do not sell unless you absolutely have to. Mechanic 2, borrow. The tax code is built around a very specific and powerful principle. Borrowed money is not income. When you take out a loan, the IRS does not consider those funds taxable because a loan is a debt obligation, money that must be repaid. So if you can borrow against your appreciated assets instead of selling them, you can access cash from your net worth without triggering a capital gains event. There are 4 common vehicles for doing this. I want to walk through each one honestly, because each carries its own distinct set of risks. Vehicle 1, a securities-backed line of credit, commonly called an SBLOC. If you have a brokerage account at a major financial firm, you can request a line of credit secured by your portfolio. The firm will typically lend somewhere between 50% and 70% of your portfolio value at an interest rate that floats above short-term treasury benchmarks. As of 2026, those rates for most retirees run between 6% and 8%. You do not sell a single share. Your stocks remain in the account, continue appreciating, continue paying dividends. The cash you draw is treated as a loan, not income. It does not appear on your tax return, does not raise your Medicare premium, and does not affect how much of your Social Security becomes taxable. In Barbara's situation, with $1.1 million in her brokerage account, she could potentially access up to $700,000 through an S block. Used carefully, she could cover the roof, the surgery, and the trip to Germany without triggering $1 of capital gains tax. Used carelessly, she could lose everything. We will come back to that shortly. Vehicle 2, a home equity line of credit, a HELOC, on a paid-off house. If you own your home free and clear, you are sitting on a substantial pool of potential tax-free borrowing capacity. Most banks will lend up to 80% of the home's appraised value through a HELOC. Interest rates as of 2026 typically run between 7.5% and 9%. The money you draw is not taxable income. In narrow circumstances, if you use the funds to substantially improve the home itself, you may be able to deduct the interest as mortgage interest, though for most retirees who take the standard deduction, that benefit is worth nothing. The serious risk here is straightforward. Your home is the collateral. If you cannot make the payments, you can lose it. Vehicle 3, a policy loan on a whole life insurance policy. If you hold a whole life policy with accumulated cash value, the insurance company will generally allow you to borrow against that cash value at rates between 5% and 8%. The loan is not taxable income. The cash value inside the policy continues growing, and if you pass away with an outstanding loan balance, the death benefit pays off the loan first. Your heirs receive whatever remains. Barbara had $90,000 in cash value in a policy she had nearly forgotten existed. She could borrow against most of it without triggering any tax event. The risk here is smaller than the other vehicles, but it is not zero. If the loan grows too large relative to the cash value, the policy can lapse. And a lapsed policy with an outstanding loan can create a sudden and significant tax bill. Vehicle 4, borrowing against business equity. If you own a small business, an LLC, an S corporation, or a closely held partnership, there are structured ways to borrow against that equity. These arrangements are more complex, depend heavily on the entity type and underlying assets, and almost always require both a CPA and an attorney before you sign anything. But the core principle remains the same. You use the value of an asset as collateral to access cash without triggering a sale. So that is mechanic 2. You borrow rather than sell. You access the cash you need. The underlying assets continue growing. And the IRS treats what you pulled out as a loan obligation, not as taxable income. I know what some of you are thinking right now. At some point, those loans have to be repaid, and that is exactly where Mechanic 3 comes in. Mechanic 3, die. I know that sounds blunt. Stay with me, because this is the piece of the tax code that almost nobody outside of high net worth planning circles fully understands. When you pass away in the United States, the cost basis of most appreciated assets you own, your stocks, your real estate, your business interests, your collectibles, gets reset to the fair market value on the date of your death. This is called the I stepped up basis rule, and it lives in Section 1014 of the Internal Revenue Code. It is one of the most powerful provisions in the entire tax code for ordinary American families. Here is what it means in practice. Barbara's late husband purchased $100,000 of stock back in 1985. Over 40 years, that position grew to $800,000. If he had sold it the day before he died, he would have owed federal capital gains tax on $700,000 of appreciation. But he did not sell. He died holding it. The moment he passed, the cost basis on that stock reset from $100,000 to $800,000. Barbara inherited it with a brand new basis of $800,000. If she sells tomorrow at $800,000, her taxable gain is zero. 40 years of capital gains erased, not deferred, not delayed, permanently erased. Now put all three mechanics together and see the complete picture. You buy appreciating assets and hold them. You borrow against them when you need cash, and because borrowed money is not income, so no tax event occurs. And when you eventually pass away, the stepped up basis eliminates the accumulated capital gains on whatever you still hold. The outstanding loans are settled from the estate. Your heirs receive the remainder with a completely clean tax slate. This is the strategy. This is what wealthy families across the country have built generational wealth around. The tax code is not hiding it. It is written in black and white in IRS publications that anyone can access. The reason it is associated with wealth is not because it is secret. It is because the strategy only works safely if you have enough assets, enough income, and enough liquidity to absorb the risks. And this is where I need to be genuinely honest with you, because the risks are real and they are the part of this story that most videos on this topic skip right past. Risk 1, the margin call. A securities-backed line of credit is, at its core, a margin loan. When the stock market drops significantly, the value of your collateral drops with it. If your outstanding loan balance becomes too large relative to that reduced collateral value, the lender can issue a maintenance call, demanding that you deposit additional cash, sell positions to pay down the loan, or both. And here is the brutal reality. The lender does not have to ask you first. In most S-block agreements, the institution has the legal right to sell your securities without your consent to bring the loan back into compliance. That means in a market crash, precisely when you would never choose to sell, your positions can be liquidated at fire sale prices. You are left with a smaller portfolio and the same debt obligation. This happened to thousands of retirees in 2008. It happened again during the 2022 downturn. It is the single biggest reason this strategy is genuinely dangerous for retirees on fixed incomes who cannot quickly raise additional cash to meet a call. Risk 2, variable interest rates. Almost all S-blocks and most HELOCs carry floating rates tied to short-term benchmarks. When rates rise, your cost rises with them. A retiree comfortably managing a 5% rate 1 year can find themselves struggling with an 8% rate 2 years later. Before you draw a single dollar, run the numbers at rates 2 to 3 percentage points above today's levels. Ask yourself honestly whether you could still absorb the interest payments in that scenario. Risk 3. The home foreclosure trap. A HELOC is secured by your house. If you cannot sustain the interest payments, whether due to an unexpected expense, a rate spike, or a reduction in income, the lender can foreclose. For a retiree on a fixed income, the worst possible outcome of this strategy is borrowing against a paid-off home and then losing that home in retirement. The house you spent 30 years paying off should be the last asset you put at risk, not the first. Risk 4. The lapsed life insurance policy. Whole life policy loans are generally the safest vehicle in this strategy, but they are not risk-free. If the outstanding loan balance plus accumulated interest eventually exceeds the policy's cash value, the policy lapses. And when a policy lapses with a loan outstanding, that loan balance can become taxable income, sometimes tens of thousands of dollars appearing on a single year's tax return. Always coordinate any policy loan with the insurance company and a tax professional who understands the underlying math before drawing anything. Risk 5. Family confusion at the worst possible moment. When you pass away, your heirs inherit not only your assets, but your debts as well. If they do not understand the strategy you are executing, they can make catastrophic decisions in the first weeks after your death. They may rush to sell appreciated assets at exactly the wrong time. They may miss the stepped-up basis advantage entirely. They may panic at the sight of a large outstanding loan balance and liquidate the wrong holdings first. Buy, borrow, die only delivers its full potential if your family understands the plan, has the documents, and can act deliberately rather than reactively when you are gone. So, with those risks named clearly, who is this strategy actually appropriate for? It fits a retiree who holds substantial appreciated assets outside of retirement accounts, a taxable brokerage account, real estate beyond their primary residence, business equity, or significant whole life cash value. Those inside a traditional IRA or 401k do not receive a stepped-up basis and cannot be leveraged in the same way. It fits someone with enough separate income to comfortably cover interest payments, even if rates climb 2 to 3 points. It fits someone with the emotional steadiness to hold through a market decline without panic, because the entire strategy depends on not selling at the wrong moment. It fits someone with a solid estate plan in place who has spoken openly with their family about the structure. And it fits someone working with a qualified tax professional who can monitor the strategy year by year and adjust when circumstances change. It does not fit a retiree who depends entirely on Social Security and a modest pension with no flexibility to absorb rising interest costs. It does not fit someone whose only major asset is the home they live in, because placing that home at risk to fund retirement living expenses is rarely a sound trade. And it does not fit someone who would genuinely lose sleep knowing a six-figure loan balance was hanging over their financial picture. If after weighing all of this honestly, you believe the strategy may be appropriate for your situation, here is a clear action plan before you draw a single dollar. Step 1. Make a list of your appreciated assets. For each one, write down the original cost, the current value, and the difference. That difference is your unrealized gain, and it represents your current capital gains exposure if you were to sell today. Step 2. Consult a qualified tax professional, ideally an enrolled agent or a CPA with direct experience working with retirees. Walk them through your specific situation. Ask explicitly whether buy, borrow, die makes sense for you. Ask them to explain the risks in the context of your numbers. If they cannot do that clearly, find someone who can. Step 3. If the strategy fits your situation, establish your lines of credit before you actually need them, while your income and credit profile are at their strongest. Lenders are considerably more willing to extend credit to people who do not yet need it. Step 4. Never draw your lines to their maximum. Treat your borrowing capacity the way you would treat a credit card limit. The fact that you can borrow up to a certain amount does not mean you should. Most professionals recommend keeping your outstanding balance well below half of your maximum to preserve buffer room for market downturns. Step 5. Pay the interest every year. Do not allow the balance to compound. The strategy functions properly only when the loan remains manageable and controlled. Step 6. Work with an estate planning attorney to make sure your assets are titled correctly so heirs receive the full stepped-up basis. This is particularly important in community property states: California, Texas, Arizona, Nevada, Washington, Idaho, Louisiana, New Mexico, and Wisconsin, where married couples can receive a full step-up on jointly held property when one spouse dies. In non-community property states, only half of the property steps up. That single titling decision can be worth tens of thousands of dollars to your family. Step 7. Tell your family. Sit your adult children down and walk them through what you have put in place. Show them the assets. Show them the loans. Show them the estate documents. The last thing you want is for your children to discover your borrowing strategy for the first time during the weeks after your funeral. Let me close with this. Buy, borrow, die is not a secret. It is not a loophole. It is not a clever gimmick designed for the ultra-wealthy. It is a legitimate, fully legal application of tax provisions that have been available to every American for decades. The reason it is associated with wealthy families is not because it has been withheld from everyone else. It is because it requires substantial appreciated assets, careful and ongoing management, and a tolerance for risk that most retirees do not have and should not feel any pressure to manufacture. If your situation fits the profile, this strategy can be a powerful mechanism for funding retirement and protecting your family's inheritance across generations. If your situation does not fit the profile, the most valuable thing you can do is recognize that clearly and not let anyone on the internet convince you that you have been missing out on a secret the wealthy have been keeping from you. The truth is more nuanced than that. The strategy is real, the risks are equally real, and what is right for you depends entirely on your specific circumstances, not on what worked for someone with a fundamentally different financial picture. If this gave you a clearer, more honest view of how this strategy actually works, please share it with a family member or fellow senior who might benefit from seeing the full picture, not just the version that makes it sound effortless. your spouse, your adult children helping you with financial decisions, a sibling approaching retirement. They all deserve an honest look at both the opportunity and the risks. And if you want more videos that break down the financial rules that actually matter for seniors in plain English without the hype, hit subscribe. New content regularly covering Social Security, Medicare, taxes, banking, and the parts of retirement that nobody bothers to explain clearly. Take care of yourself. Take care of your money.